Hey everyone, today we're going to talk about options. What is an option? An option is just a contract which gives the holder the right, but not the obligation to buy or sell an asset. That basically means that even though you buy a contract, you don't have to buy the shares or sell the shares. A contract just gives you the right, but when you trade an option, when you bet that a stock goes up, that is if you buy a call option, or if you bet that the stock goes down, which is if you buy a put option. An option is just a contract that you're using as a medium to make money. It's just a way to like make more money on a given stock move compared to like regular commons. We'll get more in detail. So what is the most important thing that you need to know about an option? That you are not obligated to do anything. When you buy an option, even if it expires in the money, first of all, always make sure to sell your contracts, because there are so many people who don't sell, and like Robinhood for some reason exercises them, and then they're in a lot of trouble because they don't have the funds for it. But always remember, you're not obligated to buy or sell the 100 shares that the option gives you the right to do. It's just that's what an option was made for. It was made for people who would want to exercise the shares, but now it's used as a derivative, or it is traded to make more money. Okay, so let's get down to the terminology. What is a call option? A call option gives you the right to buy a specified number of shares within some future period. So each contract gives you the right to buy 100 shares. So when you see that the premium of a call option is, say, for example, we go back to this Netflix example, here you might see that it says 4.80, which is the ask, and the bid is 4.30. Basically, what happens is you multiply the 4.80 times 100. So essentially, people are asking 480 for a call option, and the bid that people are willing to pay is 4.30 times 100, so it's 430. 527 is just the strike price of the option. Essentially, what you're trying to do, if say Netflix is at $500 and you think Netflix is going to go up, you pick an option that has good Greeks, and I'll get to Greeks later, but you are trying to pick an option that's trying to go up. So, and when you see this, the volume just means the number of contracts that have, closed between people. And the open interest is just the number of orders that people have put in to fill, like the amount of interest that's in the option. So you would ideally like there to be a lot of volume on your contract. So if this was the example you were looking for Netflix, you would see that $530 has the most volume, and it also has a smaller bid ask spread compared to the spread on Netflix. I know this is a lot of detail, but it'll get clearer the more in the options you are. So if you look at here, there is a $50 difference because it's 430 and 480, which people are asking for. But here on this $530 call, you see that there's only a $30 difference. Ideally, you would like the bid-ask spread to be as small as possible, because if it's a larger bid-ask spread, like $80, you'll have difficulty getting a good fill when you sell your contracts. And even when you buy them, you don't get a good price for it. So always make sure to pick that you have the least difference between it. And also, when you're choosing a strike, you would want to be realistic about it, right? Like, I know a lot of people prefer to play out of the money because it's cheaper, but you'd rather have one less riskier in the money option than a bunch of out of the money options. It all depends on the volatility and how much of a move the stock is willing to make. Anyway, we'll come back to that. So we spoke about a call. So what is a put? A put is basically the opposite of a call. Instead of you wanting the stock price to go up, or you wanting to buy 100 shares of a stock, you're going to sell 100 shares of a stock. So when you buy a put, so say the SPY is trading at $330 and you buy a put that's for $328, it's slightly out of the money, but you pick out of the money options because you like the volatility there. When you're more in the money, you lose out on the volatility. So essentially, most people pick at the money options, or just ones that are right above. But the more you like trade more contracts, the easier it gets. Anyway, a put gives you the right to sell a specified number of shares of a security. So that just gives you the right to sell 100 shares. So if, like I said, the SPY was trading at $330 and you had a put for 333. Like, I'm just explaining to you what a put does, but generally you just sell the contract. But if you were to, exercise the put, instead of selling to people at 330, what the stock price is actually trading at now, you sell to people at 333. So that gives you that $3 difference that the put gives you, which is the advantage for what you're paying the premium for. So that's where the whole concept of a premium comes, is because you're given an extra right or an extra way to make money, so you're paying the right to make that money. Anyway, so a strike price is the price stated in the option contract at which the security can be bought or sold. So when we went back to this Netflix example, we saw that 527 is a strike, 530 is a strike, 535 is a strike. And this is in Webull. And if we go to Robinhood, Robinhood has a more different interface. So this is just an example of an MU call. And when you click on 46, you get these Greeks. And I'll come back to the Greeks later, but on Robinhood, you can see that here it says strike price and it'll all be listed in like a row. So then option price, the market price of the option contract, which you already went through, which is the premium, which gives you the right to buy or sell certain things, and that's why you pay a premium for it. And expiration date is usually the date at which the contract expires, and you should always make sure to sell your options way before it expires, because when we get to the Greeks, I'm going to talk about something called theta, and you understand that every day that you don't sell, your contract loses a certain amount of theta per contract, and we'll go over that. But always make sure that if you're just starting out with options, please don't play weeklies, because those are very volatile and you can lose money in seconds. Your contract can go from 0 to minus 100% in 10 minutes. Like, it's so fast, you can lose money. So don't play weeklies, play monthlies. And the reason for that is a weekly only has 7 days to expiration and a monthly contract has 30 days. So the longer the contract takes to expire, the more expensive it is. It's more expensive because you have more time to go in the money. In the money means, like we were talking about Netflix, if the stock is currently trading at $500 and you want the stock price and you buy the strike, which, like we were going through, is like all of these are called the strikes. And if the stock is trading at $500 and you buy a strike of 530, the longer you have, the more likely it is that it can go up. Like, suppose in a week like today, for example, Trump had COVID and all the stocks tanked, right? The same way, if such an event were to occur, if you had a weekly contract, you would immediately lose all your premiums and you don't even have the time to recover the premiums. So ideally, you've lost your contract. The risk with having options is you have to be willing to lose all the money you put in, because unlike stocks, you can't bag hold these. These expire. So the longer you have, the more likely that Netflix can reach $530. So that's why the premiums on longer monthly contracts are more expensive. So the exercise value, it is basically the value of a call option if it were exercised today. So that is basically the stock price minus the current price. So basically what they're trying to say about the exercise value is that if SPY is trading at $330 and if your call is 331, like, it's zero because you are not in the money. But if you were in the money, the difference would be the 331 minus 330. So if 331 was in the money, you'd make that $1 difference. That exercise value is not really needed for us because we are just trading the contracts. We're not trying to exercise the shares. So we're just using the contracts as a means to gain more value instead of using traditional derivatives. It just gives you a more weight percentage. I'll explain that here. So we'll use Apple as an example, and this is just a random price. So if you were to buy 100 shares of Apple, you'd pay $400 times 100, which is $40,000. And if Apple were to go to 425, your return on $40,000 would be 6.25% because it's just the $25 divided by the 400 times the 100 shares you have. But if you were to buy a call option instead of buying the 100 shares, you would have the cost of having the contract is $25. So that would be multiplied by 100 because as we talked about it, each contract has the right to buy or sell 100 shares. So you'd multiply by 100. So you spend a total of 2,500. And the premium of your contract when Apple goes to 425 is $40. So your return is 60% when you have an option for the same $25 move compared to when you have a stock. I know that was kind of confusing, but when you kind of do the math on it and when you think about it intuitively, it makes sense. Like just take a while to process it. So what is a covered option? So these are more advanced and we can go more into detail later, but a covered option is basically when you own a stock and the stock price is decreasing. So while you're losing money, most people, what they do is they sell calls. So if you have a stock, you would insure your 100 shares against a call contract. And when you issue a call, you would collect premium for it. I know this is a lot more complicated, but let's go through the basics of option and then we can go through these events like options later. I just put these up like for your information and I'll just read through them. So what is a naked option? An option sold without the stock to back it up. So most of the time, unless you have a account balance greater than 25,000, you're not allowed to sell naked options. But it's just like, it's for your knowledge to know that it is possible to sell options without actually owning the stock. So what is in the money? I've been talking about in the money, and I know it may be confusing, but in the money is basically, so if Netflix is trading at $500 and you have a strike for $4.95, you're in the money by $5. And when you're in the money, your premiums go up faster because you have a bigger delta. Delta is part of the Greeks, and we'll go through that later. But here, as it says, a call whose exercise price is less than the current price of the underlying stock. It just means if Netflix is at $500 and your strike of your option is $4.95, you're in the money. Whereas out of the money is just the opposite. If Netflix is at $500 and your strike is 530, it's just out of the money. It's just intuitively, if a stock such as Netflix is at 500, anything above 500 is out of the money. And anything below 500 is in the money. Leaps is just contracts that don't expire for 2.5 years. So it's like, so if this is 2020 and if I buy contracts for 2022, they're just called leaps. There's nothing special about them, but you do not get wrecked by data on leaps. So that's the advantage of it. So we already went through this. So there are like 4 different types of option contracts. So when you buy a put, you bet that the stock price goes down. So if Netflix is $500 and you think Netflix is going to $480, you buy a put. So you just, like it says, you buy the right to sell a stock to someone else at the strike price. So if you buy a $500 put and Netflix go down to $480, the fact that you have the right to sell it to them at $500 lets you accumulate premium on your contract, and that's how the option prices increase. Selling a put is, like I said, we were talking about it. It's if you own the stock and you think it's going up. So while making money, you can also sell puts to people who think it'll go down. And when you sell the puts, you gain the premium. So you know how you pay a premium to buy an option? Here they give you the premium. So when you sell a call, you make money. And you just have to make sure that when you sell a put or a call, that the stock moves the way you want, or you risk losing all your shares, which what lets you sell the call or put in the first place, because you're insuring your 100 shares against it. Here it just says it's like underwriting an insurance policy, and profit is obviously the amount of you earn is the amount you get for selling it. You can't make more or less like when you're buying a call or put. When you're selling puts and calls, you can only make what you sell them for. And if you're wrong about it, you lose your 100 shares. So buying a call is the opposite of buying a put. Here you want the strike price to go up, as we've discussed. Netflix, if Netflix is at $500 and you think Netflix can go to $530, so you buy a call with a strike of 530, and as it goes up, you pay a premium for the call, and that premium, every dollar it increases, your Netflix contract gains a premium. Selling calls is just like selling puts. You sell someone the right to buy a stock from you, and the maximum profit you make is how much you sell the contract for. You can't make more or less. And if you're wrong about it, you risk losing those 100 shares. And so, for example, if you sell a call for Netflix for $510 because you think the stock is going down, and Netflix go to 510, then the 100 shares that you sold the contract against, you will lose all 100 shares. So you need to be very careful and sure when you're selling these calls and puts. So the most important thing to know about is time. Time literally matters because theta, let's go through the Greeks first and then we'll come back to time. So I'm sure you've seen this many times and are really unsure about what option Greeks are. So let's make it really simple here. What is a delta? A delta is basically, so if a delta is 0.45, it just says, like it says here, for every $1 a call goes up. So for example, if MU is trading for 45.76 and you have a $46 contract, and if MU goes up to 46.76, so here, as it says, for every dollar it goes up, you make 0.45. So it's like for the premiums for the delta, you multiply it by 100. So 0.45 times 100 is $45. So for every dollar MU goes up, you make $45 on your contract that you pay $57 for. So in $1, you almost break even. You just need to go $1.50 and you would have already made 100% on your call. That's the advantage of options. And gamma is just that every dollar that MU goes up, your delta goes up by 0.23. So when MU goes over $46, we were talking about in the money options, right? So $46 here goes in the money, which makes your delta increase. So that's the advantage of having in the money options. You have a greater delta. So if MU goes to 46.76, like we were talking about, this 0.45 would then increase to 0.6968. Sorry, I'm doing the math in my head. So it would increase to 0.68. So for every dollar you make, when MU is at 46.76, so if MU from 46.76 goes to 47.76, say $48, let's round off, your delta would then be 0.68. So for every dollar you make, every dollar MU goes up, you make $68. So that's the advantage of delta and gamma. Those are the Greeks that you want to have on your side. Theta, on the other hand, is like the worst. Theta basically makes your option contract lose money. So in this example, as you can see, for every dollar, it's not even a dollar. It's like for every day your stock price doesn't change. For example, if MU just remains in the 45.76 range, you lose $11, and that's a really high theta. Ideally, you'd like your theta to be like minus 0.03 to minus 0.05 depending on your contract. And weeklies have a more expensive theta, but always make sure to divide your delta by theta to get yourself an ideal risk to reward scenario. Anyway, so for every dollar okay, again, I was wrong. So for every dollar your stock doesn't move, like we were saying, 45.76 range, if MU doesn't move, your contract, which you paid $57 for, loses $11 every week. And this looks like a weekly contract because of the high theta. So say if you pay 57 on Monday and MU doesn't change at all the whole week, you lose $11 every day. So by the time you're a Friday, you lose all $57 you paid for contract. So always remember, theta is very important. You have to see how much money you lose if the option doesn't move your way. Unlike delta and gamma, Theta is like the evil. It's like not your friend. It's always trying to make you lose money. Vega, on the other hand, has to do with volatility. So volatility, as you can see here, is measured from the wicks, and it's also measured per contract depending on the amount of interest there is. 41% is a good volatility range to get into. Anything over 100% to 200% are high volatile contracts. As you can see, Vega also increases your contract. So every 1% implied volatility goes up, our call option goes up $1 here, like 0.01 times 100. Like we said, each contract has 100 shares. So if you have an already highly volatile contract, and if a stock price drops, that generally drops your volatility. So you not only lose money on theta, on delta, you also lose money on volatility. So always make sure your volatility is relatively low or normal compared to like high volatile options. Because if the stock doesn't move the way you want it to based on your setup, or if some external event screws it up, these are all factors that can destroy your contracts in seconds. Rho is interest rates, and that's honestly a more complicated explanation as to how an interest rate affects your contract, and we can talk about it in more advanced sessions. Anyway, so we spoke about all the Greeks, right? And we already spoke about volume. That's the number of contracts that's traded in a day. And open interest is like the number of fills that are in for like asks and bids. People want to buy and sell that have not been filled, and the interest in it. And so here we go back to time. So why is time important? Like we were talking about, the lesser time you have for a contract to expire, the more volatile it is, and the more likely you lose money as well, or you make money. People play weeklies if they're very confident in a stock move. Like if a stock price goes against you, compared to a monthly or a leap that we said 2.5 years or longer term contracts, a weekly loses a percentage larger than a monthly. The more you play these options, the more you can see these percentage changes and why a weekly option is more risky than a monthly option. That's why 85% of all option contracts expire worthless. You need to be very strategic when you're trading options. A lot of people, like James, for example, think options is like gambling and you don't need the Greeks, but Greeks are very important. All these days, stocks only went up, so your option Greeks didn't matter because anything you bought, you just made money. But now, in choppy markets, options are like the easiest way to lose money. Like right now, trading options has been more complicated than it normally is. So what are the different types of options we've spoken about? You can buy puts, you can sell or write calls, and this is when in a bearish scenario. When you're bearish, you buy puts because the stock goes down, or you sell calls because you know the stock won't hit the call strike that you sell. So when we're talking about Netflix is trading at $500 and you sell a call option for 510 and Netflix go to 480, you keep the premium and you keep your 100 shares. So you win in both scenarios. And when you're bullish on a stock, it's the opposite. You buy calls and you sell puts. You sell puts because the stock goes up and you collect the premium from selling the puts and you don't lose your 100 shares. And here, when it's choppy or when it's flat, here, for example, I put this up because this is how most traders lose money in a choppy market. When a stock goes up here, this is when your contract is the most volatile. So ideally, you want to sell here because even though the stock goes down and comes here, goes down and comes here, you think you have the same premium, right? The same amount of money you made from buying here all the way to here. But options, we were talking about theta and delta. When markets chop, when markets go up and down, when it goes down, you lose more money than you would make going up. So your contract is worth less here, even though it's the same price as it was here. It's worth less here than it is here. And similarly, when it goes down here and comes back up, it's worth less than it was worth here. So when the market chops like this, do not play options or only day trade this momentum up or this momentum down or this momentum up. When your options chop like this, you lose all the gains that you would get. So I want to make sure in a choppy market, do not trade options. Buy stock or trade the momentum or direction. Choppy markets are markets that move sideways, and they are not good for option contracts. And I know a lot of people are confused about this, so I'm just going to go through this one more time. Most option sheet, when you pull it up, it looks something like this, and it looks really confusing, so let's go over it. Volume, we went over volume. It's just the number of contracts that I traded for that. So for Netflix, if it's $530, which is the strike, there's 2,860 contracts that were traded for it. So that's a pretty good volume for it. A lot of people are interested in it. It's a very liquid stock. The last price is just the premium that, so if you were buying a call, here it says call, here it says puts. So if you were buying a call, someone paid $405. 4.05 times 100, as we've discussed, is $405. Someone paid $405 to purchase the right to buy 100 shares at $530. So even though the ask is $425 and the bid is $395, generally when you put it in the bid, it doesn't get filled. So when you see a last price, you normally would like to put in the last price because it's generally the mid price that gets filled, which is the last price, and you're more likely to get filled faster. So, and here the ask is just what people are selling for, the bid is what people are buying for. And I generally put the middle price between the ask and the bid, and here 405 is a good price to get your contract filled for Netflix. And here is the put section. Here, this is a $535 put for Netflix, and here it's $3,400 people are willing to pay for it, and $3,575 people are willing to sell for it. And here you can see the last price is $33.90, which is $3,390, which is less than the bid and the ask, and it generally doesn't get filled like that. But if you're lucky to get a low fill, good for you. And here you can see that the calls declined greatly and the puts increased vastly, and that's because today Netflix went down and people bought puts and people made a lot of money. As you can see, 100%, 120%, versus if you were holding calls, people lost 60% and 69%. And I hope this helped everybody, and thank you.